Something major is happening behind closed doors, and almost no one is talking about it. Over the past few weeks, multiple high-level banking sources have begun quietly repositioning their assets, preparing for what could become one of the most significant currency events of the decade: the potential revaluation of the Iraqi dinar. Insiders describe it as strategic accumulation, silent, systematic, and happening across major institutions in Europe, the Gulf, and even the United States. The question now isn't if this revaluation will occur, but when and under what global circumstances. And if the patterns we're seeing hold true, this could trigger a domino effect across the global currency markets, from oil-backed trade agreements to the growing influence of BRICS and their gold-based systems. Before we continue, if you want to stay ahead of the mainstream narrative, subscribe to Global Currency Watch, give this video a like, and share it with anyone who needs to understand what's really unfolding. We release updates almost daily, breaking down the stories that major networks won't cover until it's too late. Your engagement helps this information reach more people before the window closes. Now here's what we'll uncover in this investigation. In Part 2, we'll explore how large financial institutions are quietly repositioning, and what leaked bank memos reveal about their expectations for the Iraqi dinar's next move. In Part 3, we'll connect these developments to Baghdad's monetary reform program and new signals from the Central Bank of Iraq. In Part 4, we'll examine how BRICS and Middle Eastern oil alliances could accelerate this revaluation window faster than analysts expect. And finally, in Part 5, we'll discuss what this means for global currencies, the USD's future position, and why some insiders believe a reset phase has already begun. Stay with me. What you're about to hear may redefine how you see the entire global currency system. Over the last 60 days, there's been an unmistakable pattern emerging inside the international banking sector. A quiet but deliberate repositioning of liquidity. Several regional reports, including one sourced from a European correspondent bank tied to Middle Eastern trade settlements, show unusual upticks in dinar-related remittance activity. Not in the retail market, but in institutional transactions, movements that almost never occur without prior coordination at higher levels. According to two senior financial analysts we spoke with, both of whom requested anonymity, several multinational banks have reclassified a portion of their Middle East portfolio exposure, moving it from speculative holdings to emerging currency reserves. That's a subtle accounting maneuver, but it sends a powerful signal. These banks are preparing for a potential upward correction in the Iraqi dinar's value. Another layer of evidence comes from leaked internal guidance memos. In one, dated early October, an internal compliance division warned its staff to anticipate enhanced monitoring of Middle East currency transactions related to reconstruction and oil settlements. That language, especially when it appears in a compliance document, usually hints that senior leadership expects near-term regulatory adjustments, often preceding a revaluation or policy shift. Meanwhile, Gulf-based correspondent institutions have begun tightening their reporting thresholds on USD to IQD conversions. In plain terms, they're watching the dinar more closely than at any time in recent years. This mirrors behavior last seen in late 2016, just months before Iraq's central bank initiated its last structural currency reform. And it isn't limited to private banks. Some regional sovereign funds, particularly those tied to energy exports, are rumored to be stockpiling short-term instruments denominated in dinar. That's not speculation, that's hedging. And hedging happens when insiders expect volatility, specifically upward volatility. All of this points toward one consistent narrative. Major financial entities are positioning quietly, not for a collapse, but for a surge. In the next section, we'll trace how these banking movements connect directly to Baghdad's ongoing monetary reform, and why the Central Bank of Iraq's latest statements might hold the key to understanding when, and how, the revaluation window could finally open. Stay with me. While the banking sector quietly adjusts its balance sheets, the real pulse of this story beats inside Baghdad. specifically within the walls of the Central Bank of Iraq. Since early this year, the CBI has been implementing what officials describe as a monetary restructuring program. Publicly, it's framed as a modernization effort, improving liquidity, stabilizing inflation, and aligning Iraq's currency systems with international standards. But beneath the official language lies a far more strategic intent: preparing the dinar for international convertibility, a critical prerequisite for any credible revaluation. Insider documentation obtained from parliamentary finance committees reveals that the CBI has been gradually tightening the dinar's supply while simultaneously expanding its foreign reserve base, primarily in gold and US dollars. That dual move, contraction of circulating currency and expansion of reserves, is textbook positioning for a value correction. In mid-September, CBI Governor Ali Mohsen Al-Alak made a carefully worded statement during a televised economic forum. Iraq's monetary system is entering a phase of structural balance that will allow the dinar to reflect the nation's true economic potential. Analysts familiar with central bank language know that such phrasing rarely appears by accident. It's diplomatic code for controlled appreciation, the slow upward adjustment of a currency's official rate. Even more telling are Iraq's ongoing negotiations with the IMF and the World Bank, particularly regarding exchange rate transparency. Multiple reports indicate that Baghdad is seeking new mechanisms to settle international oil contracts in dinar-linked instruments rather than strictly in US dollars. That shift, if finalized, would dramatically increase global demand for the IQD, laying the groundwork for revaluation under legitimate macroeconomic justification. Furthermore, a quiet legislative change passed in late August authorized the central bank to issue higher denomination notes, not to inflate the currency, but to streamline transition when a new valuation band is introduced. Such a move is typically seen months before a formal repegging or float adjustment. Put together, these threads, reserve growth, liquidity control, regulatory alignment, and international negotiations, outline a clear roadmap. Baghdad isn't guessing. It's engineering a foundation for the dinar's next phase. In Part 4, we'll connect these domestic maneuvers to the larger geopolitical forces shaping them, from BRICS gold initiatives to shifting oil trade dynamics, and how these external pressures may be accelerating Iraq's timeline far beyond public expectations. Stay tuned. To understand why the Iraqi Dinar Revaluation is drawing so much quiet attention, you need to zoom out, far beyond Baghdad. Because while Iraq fine-tunes its internal monetary reform, a seismic realignment is happening across the global financial landscape, and it's being led by a coalition determined to challenge the dollar's dominance. Over the past year, the BRICS alliance, Brazil, Russia, India, China, and South Africa, has accelerated plans for settlement systems backed by gold and regional currencies. This movement has already expanded to include Saudi Arabia, the UAE, and other energy-rich nations. Their collective goal: to conduct trade in non-USD terms, weakening the long-standing petrodollar cycle. Iraq, though not an official BRICS member, sits at the crossroads of this transformation. Its oil exports and strategic partnerships tie it to both Western financial networks and Eastern trade corridors. And as BRICS pushes for gold-backed alternatives, Iraq's accumulation of precious metal reserves suddenly takes on a new meaning, a bridge between the old system and the one emerging. Analysts tracking this development believe that if BRICS formalizes a gold-linked clearing unit in 2026, early mover nations with undervalued currencies, like Iraq, could become test cases for hybrid exchange mechanisms. In plain terms, the dinar could revalue to anchor its own oil trade settlements, aligning with the broader commodity-backed trend sweeping Asia and the Gulf. Several unpublicized diplomatic cables suggest that technical consultations between Baghdad and Beijing have already occurred regarding trade settlement interoperability, a subtle phrase for cross-currency convertibility. If true, it means the Central Bank of Iraq is quietly ensuring that any future RV fits inside a multipolar gold-supported settlement grid, not the traditional IMF-centric model. Meanwhile, Western banks are watching this shift closely. An internal risk memo from a major European institution, circulated in late September, warned portfolio managers to anticipate increased volatility around Middle Eastern currency adjustments linked to commodity trade diversification. It's the kind of language that surfaces only when global desks sense a macro event approaching. The takeaway is clear. Iraq's revaluation momentum isn't occurring in isolation. It's a single thread woven into a much larger tapestry, one that could redefine how value, energy, and sovereignty are priced across nations. In Part 5, we'll bring all these signals together, from Baghdad's reforms to Wall Street's hedging, and outline what may lie directly ahead, the potential scenarios for a global currency reset, and what it means for the dollar, the dinar, and you. As the pieces fall into place, a larger pattern becomes impossible to ignore. Major banks adjusting exposure, Baghdad engineering structural reform, BRICS constructing a gold-linked ecosystem, all these moves converge toward a single outcome, a controlled rebalancing of global value. In plain language, a currency reset, not the chaotic collapse that doom headlines love to sell, but a deliberate transition of power between monetary systems. For years, the global economy has been tethered to a dollar-centric model that rewarded financial speculation over tangible assets. Now, nations holding real resources, oil, minerals, and gold, are asserting monetary independence. Iraq's push for a stronger dinar fits squarely within this narrative. A nation reclaiming its fiscal sovereignty after decades of artificial suppression. Insider economists describe what's coming as a phased reset, where select currencies quietly appreciate while others slowly lose purchasing power. It doesn't happen overnight, and there's no official announcement. Instead, markets reprice value step by step under the cover of technical adjustments and monetary policy alignment. If this pattern holds, the Iraqi dinar could be among the early movers, a small currency with oversized symbolic impact. Already, private banking desks in Europe are advising clients to diversify into tangible reserves, gold, oil-linked ETFs, and select emerging market currencies. Not because of panic, but because institutional risk models are recalibrating for a post-dollar equilibrium. Meanwhile, the IMF and World Bank continue to hold closed-door consultations with Middle Eastern finance ministers, language that often precedes coordinated rate management. But make no mistake, once one domino tips, others will follow. A revalued dinar could pressure neighboring economies to adjust, triggering a chain reaction across the Gulf and parts of Asia. That, in turn, reshapes how the world settles trade, stores wealth, and measures stability. For the average observer, these developments may seem distant, technical, abstract, yet their consequences will reach into every financial system, every savings account, every investment portfolio connected to the global grid. It's not about whether the revaluation happens. It's about when the balance of power in currency markets fully shifts. If you've been following this investigation, you already understand this isn't just about the Iraqi dinar. It's about a global transformation that's been years in the making. To stay ahead of what comes next, make sure you subscribe to Global Currency Watch, like this video, and share it with others who need to hear the real story. Not the filtered version mainstream outlets will deliver months from now. We'll continue tracking every signal, from new IMF guidance to the next CBI press briefing, as this historic reset unfolds. Stay alert, stay informed, and as always, follow the money.